Good morning, good afternoon, good evening, wherever you are. I'm your host, FD for SageFact.tv, and I thought I would contribute my 2 cents to the much trumpeted United States Genius Act, or Guiding and Establishing National Innovation for US Stablecoins. That's what Genius stands for. The Genius Act that just got passed by the US Senate and now are waiting for Congress to see if they can vote on it and pass, or they might end up diluting it. But that in its own right was a remarkable milestone for the crypto space, starting to get that acknowledgement and acceptability from the authorities, which then opens the door for TradeDeFi to come and join out. Here I'm talking of financial institutions, TradeDeFi, or your old banks and all the other financial institutions from the US, and where the US leads, probably find that most other countries follow, including the likes of the UK and some in Europe. But before I jump in, guys, please know that what I'm going to share with you are solely my opinions, and this is a bill that has not yet been passed into law, but at some point things go well, might end up being passed into law. These are just my own opinions. It's meant for information as well as entertainment purposes, and it's not meant for financial advice of any sort. So please do your own research on these things and come up with your own rounded knowledge from different sources. So what is the Genius Act that was passed by the US Senate over the past few days? Genius Act. Genius is actually an acronym, and it stands for Guiding and Establishing National Innovation for US Stablecoins. That's what it means. So the Genius Act is a legislation that requires dollar-pegged stablecoins to hold dollar-for-dollar reserves in short-term government debts or similar products overseen by state or federal regulators. This is just a summary, of course. I'll leave some links to the actual document if you want to read about it. So in this video, what we want to do is to attempt to unpick the potential impact of the Genius Bill or Act if and when it becomes law for both TradeDeFi and the crypto space. What are the pros and cons of this bill to each of these? I'm talking of TradeDeFi or traditional finance as well as the crypto space. So we'll be looking at the short-term, medium-term, and long-term impact for both. Let's start with the pros and cons from a crypto perspective. The pros, let's start with the regulatory clarity, where the Genius Act establishes a stablecoin as a distinct federal regulated asset class, removing murky legal ambiguities. It also enhances consumer protections. Why? Because it mandates one-to-one backing, monthly disclosures, and priority claims in issuer bankruptcy, mitigating risks of depegging or collapse. So instead of what happens when central exchanges or other DeFi companies or entities go down, they prioritize other people, yet they're going to prioritize consumers. Institutions may also adopt the stablecoins, and that could be a catalyst. Clear rules, lower barriers for banks, fintechs, and retailers, for example, Visa and Meta, to integrate stablecoins, fueling mainstream use. And I think this could also be the death of centralized government-issued currencies, because all of a sudden banks will be able to create their own currencies. So you'll be deciding whether you want to hold a Barclays dollar or pound, an HSBC dollar or Santander dollar or Lloyd's dollar or pound or whatever it is. This will be good because it means you've got choice. You are not being forced to hold what you don't want to hold. Anyway, it also got dollar reinforcement, where the dollar will be anchoring the digital payments, better positioning it against global stablecoin competitors like China's ECNY. What are the cons? Well, always you've got to look on both sides. You got concentration risks, where limiting backing to short-term treasuries and cash concentrates issuer rate, heightening systemic risks if large-scale redemptions occur. Yeah, that's to be expected as well. And you always want to plan ahead. And you got the Federal Reserve interference. That's not a good thing. Massive stablecoin demand for treasuries could disrupt short-term rates and monetary policy effectiveness. Competition is also going to be squeezed. You're talking of those smaller stablecoins, especially the crypto-backed ones, or what do they call them? Algorithmic stablecoins within the crypto space. They're going to be squeezed out because legacy pressure and capital requirements may advantage larger incumbents, hindering smaller crypto-native stablecoins. And you also have conflict of interest loopholes. Critics note that the bill doesn't prohibit presidential family members from profiting, raising governance concerns. I know Trump has got his own stablecoins, isn't it, through his company. But those are the pros and cons from a crypto perspective. Moving on, the pros and cons from the traditional finance perspective. The pros, it lowers treasury yields and borrowing costs. And this is due to a surge in demand for short-term treasury bills, which could trim financial costs for the US government. And another pro is around market modernization, where instant blockchain-based stablecoin payments can streamline cross-border and domestic settlement, boosting efficiency. Regulatory oversight as well, which brings issuers under anti-money laundering or KYC and audit regimes, which enhances transparency, reducing illicit finance risks. What about the cons or disadvantages? Well, liquidity fragility. If stablecoins dump treasuries during a panic, yields could spike, impairing financial stability. I think some people could actually be manipulating that unless they also bring in controls around market manipulation, because I can see people making millions just by trading stablecoins. points. That's crazy, right? Liquidity crowding out. Heavy stablecoin treasury demand may shrink safe assets available to banks and institutional investors, raising their costs. Another disadvantage is this distortion of policy. The Federal Reserve's control over short-term rates may be diluted. I don't think that would be a bad thing at all, but that may also complicate inflation management. Oversight complexity, where balancing federal and state rules might be an issue, and covering loopholes, for example, presidential interests, which adds regulatory complexity. So in short, guys, I think as far as the crypto ecosystem is concerned, this allows the space to gain legitimacy, consumer safety, and adoption potential, but risks become entrenched. Regulatory capture looms as well, where the whole space could be captured via regulations. As for traditional finance, I think it gains innovation in payments and reduced treasury cost, but also increased liquidity risks and systemic fragility. When it comes to timelines, if you are looking at short term, say from 0 to 6 months, the bill proceeds to the House, likely before the August recess, and if enacted, triggers initial reserve building, boosting short-term treasury yields decline. Major players like SECO, Tether, and legacy institutions begin compliance routines. I'm talking of audits and disclosures. Market volatility may fluctuate as participants adjust allocation. Medium term, you're talking of 6 months to 3 years. Potential stablecoin arms race, where fintechs and retailers launch compliant tokens, expanding payment options. I don't know if that will actually be a good thing, because look at what's been happening with PayPal. I don't think many people use it unless you use it via PayPal. Of course, I've never seen the purpose or the need to use a PayPal stablecoin. Maybe in the future, right now, no. Treasury demand by issuers becomes structural, possibly suppressing short-term rates by 10 to 20 basis points. Federal Reserve, in collaboration with Treasury, monitors systemic liquidity and may develop guardrails or caps, which is capital controls. And as far as long-term is concerned, you're talking of 3 years plus. The field may have grown by then or matured, but the tokenized dollar becomes embedded in the global financial system, facilitating real-time settlements and cross-border transactions. But then with that, you'll see the likes of Western Union and other cross-border payments entities. They may be out of business by then. Competitive pressure could lead central bank digital currencies or tokenized bank reserves to emerge. Stablecoin monitoring might evolve into micro-prudential tools. The Federal Reserve might introduce limits on issuers' assets concentration if stability concerns persist. So my final takeaway as far as this Genius Act is concerned, I think it marks a pivotal moment, transitioning stablecoins from speculative crypto to regulated payment instrument. It encourages innovation and adoption, but risks entrenching incumbent players and tying crypto health, government asset fluctuation that could be a risk. The bill modernizes the backbone of payments and enhances monetary flexibility, but introduces new systemic vulnerabilities and regulatory burden. Its success hinges on robust oversight and dynamic policy adjustment. So those are my thoughts as far as the Genius Act is concerned, should it become law once it's seen its way through both houses of Congress in the US. What are your thoughts? Let us know in the comment section, guys. Until the next one, this is FD for CITFA.TV signing out for now. Bye.